Hi, this is Randy Finney with Right Side of the Chart, and today is Tuesday, December 8th, 2020. What we're going to do in this video is start out with a very brief update on the broad markets. There's not really anything new to report, and any new developments, that is, or at least anything significant. And in the rest of the video, we're going to take a look at the banking sector and some of the big bank stocks. I think there's actually certainly some important developments to point out there, and maybe some potential trading ops setting up. All right, so let's start out with the broad market, and we'll start out here with QQQ. This is a daily chart. No, nothing's really changed on the daily chart. We've made a marginal new high. We're a slow, steady grind higher. A lot of just nothing but green candles lately, but small candles, very low, hardly any volatility recently. And again, these are potential divergences, meaning that as of now they're not confirmed because the PPO needs to turn back down, put in a bearish crossover, and you can see the RSI turn down, and then we'll have that confirmed divergence. The trend line I'm watching on the daily chart is this one right here. Let me draw over it. This is probably our most significant trend line right there. So that's what we need to see to get a sell signal on this daily time frame. A solid break down below there, red candle, and a solid red close. Of course, that's blue. I don't have time to toggle around all the colors, but that's what I'm looking for there. And on the 60-minute chart, what we have, I'm going to zoom in a little tighter here. We do have a trend line that was broken. We dipped below. This is the trend line I was also watching on NQ, the NASDAQ 100. So we had a breakdown, but not really a sell signal. Number one, it wasn't impulsive. We just limped down through there, nothing big. And we've had a little bit of a kickback sense. We are below trend, and that is probably the most significant development to note right here. However, as I often say, even if you're only trading the NQs or QQQ, you also want to watch SPY. And on the SPY 60-minute chart, which, by the way, I would just want to point out the divergence is still very much intact on the NASDAQ 100 60-minute charts as well as the daily. But when we flip over to SPY, the S&P 500 tracking ETF, you can see that trend line that I was waiting for a near-term sell signal. The minor uptrend line is still very much intact right here. That's the minor uptrend line. 60-minute chart we're looking at here. There's your divergence, continues to build right now. And so no sell signals as of this time on the S&P 500. So really nothing new to report, but that's what I'm watching. If and when that breaks, and remember, QQQ is already below trend, so really at this point in time to get a sell signal, what we'd want to see is a solid break and or 60-minute close below there, as long as QQQ remains below that trend line. And obviously you'd want to see and most likely expect QQQ to follow. So that's it. Markets remain in an uptrend without any sell signals at this point in time. Daily chart of SPY, again, the trend line is not as clear, but that's probably our comparable trend line. That is the comparable trend line there on the 60-minute chart that we need to take out. And there's your divergence building on the SPY daily chart. Okay, now let's talk about banks here. This is where I think it's interesting. That's not what I wanted. I wanted to go right here to banks. Before I get into that, I will mention, yes, the trend is up. Why aren't there a lot of trade ideas? Well, I have in recent months thrown out quite a bit alongside trade ideas, many of which have already hit their targets. And here's the thing too, is I'm not seeing any objective long entries. You want to chase a trend, buy something because it's going up, great. You can do that, and it does work in a strong uptrend. You can keep buying, buying, buying. It's like a game of musical chairs where the music's playing, you can go long. But what I like to look for are objective, clear, bullish setups. And last sector that broke out was XLE. I highlighted it just before the elections. This is the energy sector. I did it via 3 ETFs, XLE, which since broke out right after the elections and has already rallied 38%, and it's no longer objective. We're almost to my final target right there, about $42, close enough. So in other words, the train's left the station, and there's just not many other sectors that or really hard any that I can come across, that I've come across so far, that are setting up poised to break out. So again, if you're long, milk the trend as long as it lasts. And if not, you want to wait for setups. You can draw a trend line on a lot of these sectors like XLE and wait for the next sell signal there. The other ones were related, were XOP, again, beautiful bullish falling wedges, but I'm not seeing a lot of these patterns anymore. We're just seeing stocks going up, going up, going up, about 44% since the breakout on XOP, and the final one was XES. Same thing, bullish falling wedge, breakout, back test there. Since the breakout and back test, about a 62% run, again, just since the election. I guess that was a final target I had listed on there at the time. It's already been exceeded, and really the next resistance is that reaction high. There's not a lot right here, but the same thing. You can see the energy stocks are getting heated here, quite overbought. Last time we were overbought like this. You can look down on the RSI here. There's our overbought conditions. And last time we were overbought was right there. Remember, bigger picture on the energy sector, it is and has been solidly entrenched in a bear market now for many years. It's the sector of the S&P 500, but when I go to this weekly chart back here, you can see energy peaked back in 2014. And so this is nothing more than a bear market rally. Now let's talk about what may be bear market rallies. Back to the point of what I was trying to do here, covering the bank stocks. I'm going to use this watch list. There's a watch list that populates. It's off the screen. You can't see it on the video recording here. But I'm going to start out, and I'm not going to go through a million bank stocks. No need to do that. We'll look at some of the bigger U.S. banks, maybe a few of the big Canadian banks, and one or two other international banks here to kind of get a picture of where the banking sector is going to go. Now, let me just start out by saying I'm doing this because I do think what you're hearing from me lately is we're hitting some extremes, and I think a big correction will be coming sooner or later. It could come after the first of the year. We could, at this point, you're going to get all the buzzwords: Santa Claus rally, which is the tendency for stocks to rally into year end, January effect, which is small caps outperforming January. Keep in mind, a lot of that's already happened. We've had a pretty healthy rally up to this point, so is there more for a Santa Claus rally to come? It's possible, but most years, Santa Claus rallies after stocks have been kind of lagging behind. Usually, third, fourth quarter can be kind of soft. And again, the small caps, they've certainly had their January effect early this year. So I'm going to talk about more and more. I'm going to talk about setups for the next leg down when we finally get a sell signal. And more so than that is there's always going to be some sectors that will turn down before the broad market. You're not going to see all 11 sectors peak at the same time. So what I'm focused on now are the banks, which are a subsector of the financial sector. When you look at the ETF, XLF, remember, it's not just banks. You have insurance companies and everything else. But I can start there because this is a very popular, widely traded ETF. And here's what I want to show you. What stands out to me the most, and we'll get back to the individual banks in just a second, is this trend line right here. This is the trend line off the 2011 lows in XLF. Very well defined, lots of reactions. I'm circling those reactions here. And then we broke down that March drop into the COVID lows. We broke down very impulsively. We back tested once from below, and we're currently back testing. So I can say this. It is an objective short entry here, just like it was on that last back test, just like it was on the breakdown. In trading, if you're going, long, you want to go long, or at least I do, on breakouts above resistance or a bullish chart pattern, as well as pullbacks to support. And when you short, you do the opposite. Once you've, if your outlook is bearish for security, or it's already broken down, like this, in this case, then you either short a breakdown of support, like on the trend line there, or a rally back into resistance. So there it is. The case can be made. Now the rally is strong. This is one of the most, again, it's not we're not in a blow off top scenario or anything like that. The market's not running away. It's posting small but steady gains lately. And so again, to short now just about anything, especially including the financials, because they're in an uptrend, that's a counter trend trade. Clearly a counter trend trade really without any sell signals. Remember that a rally into resistance, as I'm pointing out here, is an objective time to short, but it's not a sell signal. And so what can happen? Well, a lot can happen other than we reverse here, which is certainly a possibility. And if so, there's a big old gap right there to target for a very quick pullback trade, about 25.38. But what we could do as well, we could continue to back test for a while, move up this trend line. We could take out the trend line, take out those previous highs. But again, the point of this video is to start highlighting some sectors that, if and when, especially if we start to get some sell signals on the broader market, then this is one that I think may lead the way down or outperform for those of you looking for shorts, or maybe you're long the financials and looking when to get out. So let's do that. We're going to go through those individual big banks on the weekly time frame first, and then we'll move over to the daily time frame. Okay, we're going to start out here with the largest U.S. bank. That's JP Morgan Chase Company. And so what I see when I look at this chart are really three big bull and three big bear markets. You have a bull market back here. The trend line was fairly well defined. This was called the Asian contagion, for those of you that were around and remember that. You had that markets, you had a quick meltdown back in 1998 and snapped back. So that's pretty much our bull trend line with that brief breakdown there. And like many, not all, but many bull markets end with divergent highs. Remember, we're looking at weekly charts here. We're going to go through these weeklies to paint the bigger picture. I don't use weeklies as an exact timing indicator, but it helps to look at something. Are you in a bull trend that's, it's well intact and maybe looking for an objective level to add to a trade, maybe a pullback to a trend line, or are you looking at a trend that is likely over and you're looking to catch a major top or bottom, an inflection point? And so there it is. Bull market number one was from about the mid 90s all the way up to when the dot-com bubble burst back here in the tech sector, but that took everything down with it. And then you had bull market number two from 2002 up to the 2007 highs, and again, well-defined uptrend line, negative divergence, common traits of end of a bull run on a weekly chart. And now you probably heard me say this in the past many times, though, if there's one term I assigned to the bull market since 2009 when the Fed started coming in with their grand experiment, quantitative easing and zero interest rate policy, this is the term I have for the bull market is supersize. So this is a much larger bull market, and that's a clear, well-defined trend line to me, just as well-defined as these others, but much larger. Here's all the reactions we had. There's 2009 lows in March, a lot of reactions here, a lot more reactions recently, and then, I'm going to zoom in nice and tight, an impulsive breakdown. So when I look at this, even though it spans over a decade right now, or this bull market, I see a bull market in the banks that have ended. It ended already. They topped like many other sectors. Tech is not the entire market. It certainly influences the index, has the largest impact. But I see a bull market that ended in JP Morgan and many other banks back here, and really when the COVID lows hit, the March drop. And that's it. We're below trend. We had a back test there, or near back test. We're close to it there, but we are below trend. Now, what you can see here are some circles. And so you might be saying, oh, well, this is crazy. The rally is so strong lately. Well, again, let's just look at bigger picture for a second. Let's be objective. And what I've noted here is the drop off the previous highs into that March low was 46%. The last bull market ended in 2007, late October, around October, and you had this initial leg down right here, and that was exactly 40, well, give or take, round it off to the nearest percent, 46% as well, followed by a sharp counter trend rally, and then before all is said and done, 72% drop. This is how most, even corrections work. You don't usually see a one and done, that's it, bear market over, correction over. It is possible, I have seen it, but it is unusual. Most corrections play out in waves, or even bear markets for that matter. In that one, you had a 52% initial leg down. Remember, this was the biggest bear market in back then, especially with the Nasdaq dropping, I think over 70% or somewhere around there, back in off the 2000 highs. But what I wanted to do is just kind of put things in perspective. For those of you that might say, well, this rally that we've had lately is just too strong. And again, and we're looking at the banks here. There's other sectors that healthier, but this is the one I'm zeroing in on right now. And so not only is that comparable right now to the previous drop. The only thing about this one, it was a lot faster because of the shutdown. So this one took a little while to get there, but then played out like that. And so far, when you look at another measure to do to try to compare to those previous drops, is we'll turn off, well, I can't do that. We'll just go to a different board and measure the, put up the Fibonacci retracements. So there was our bull market high, measure down to that initial, that first leg down, and put on, I'll probably have to turn on the 78.6% Fibonacci retracement line. That's about where we retraced. So we retraced almost all, about over, a little bit over that 78.6 retracement. And right now, where we're at from the high to the low in March, right about there. We're coming up on that same 78.6. So far this rally has actually underperformed that one in percentage terms as far as retracements go. So really tracking similar to, put all those circles back on, how these previous moves played out. So again, bigger picture stuff. It's going to feel super bullish at the top. It's going to feel super bearish at the lows, and it's going to feel super bullish again if this is just a, at least in the financials here, a bear market rally, which by just about all metrics on this chart, that's what it appears to be at this point in time. Only time will tell if we're gonna, if that's gonna be different. Maybe we come up here if we do continue to rally much beyond this 119-ish resistance, about 119, 120, about where we're at now, give or take on the, again on the weekly chart. Then you have the trend line is the next resistance level. We'll move on, and I'll get to these on the daily chart to kind of hone in on some levels for if you're looking to trade these, exit these as longs or enter shorts. Or both. Bank America, same story really. You have trend lines going back for years. There's our uptrend line back in the 90s to the top right there, divergent high, and that was our bear market played out in waves like that. Then we had a new bull market right here, and we broke down. There was a 2007 top, and again, these are waves. That was a sharp counter trend rally right there. With more to come before all was said and done. And now when we zoom in tight, remember, bigger bull market, call it the supersized bull market, and so you have a much larger uptrend right there that was also clearly taken out. And so again, there's your similarities back to 2007, your counter trend rally, and after the first move down, there's your first leg down, counter trend rally, and we're at resistance now, still well below trend. Next one up would be HSBC. That one actually looked better than most down here at the lows recently. You had a big divergent low on the weekly chart here, and since then you had a nice 57 or so % rally, but we've run into resistance. So that's something to note. That's that previous reaction low back from 2016 would be the resistance level there. It's not super resistance. This is a more solid resistance level, about 35, 39, but it is that previous reaction. Traders will look at that. So there's one at resistance. And let's just move on to the next one. Again, trying to paint the bigger picture here. Citigroup. The trend line that I'm using for Citigroup is this trend line here. It comes off the 2011 lows. I like the number of reactions on there to help validate it, and the same thing was broken in that meltdown in the March lows. Back tested, and we're back testing again. And there's also a resistance zone you can see right here. Runs it from about around 60 to 64, 65 right there. And it's those two lines. So there's another one of the major U.S. banks right there at pretty significant resistance right there. Trend indicators are bearish as well. WFC, I did point out this one a few months back as one of the more bullish ones because again, Wells Fargo had a nice big divergent low right there, strong divergence, and as such, it's actually as would be expected, it's outperformed many of the other bank stocks on the way up, about 43% right there. Next resistance, I don't have much until about that 33.60ish level. So looking better than some of the others, at least here on the weekly chart. RY, Royal Bank of Canada. Pretty good resistance right here, about 83 and a quarter. Nothing major, but we do have some reaction highs right there, previous reaction highs, and that's where we're at on RY. Close to being overbought. We're going to look at that here. You know, typically you want to be looking to close longs or go short on overbought conditions, and you want to go long on these oversold readings down here on the bottom. You know, had you done that in the past, you would have been rewarded. So, especially in a bull trend, oversold is usually one and done. We get the quick readings, and the bull trend, overbought can stay overbought for a period of time, or you get those double tap readings or divergence like that. TD, Toronto Dominion Bank, as in, you know, like the TD Ameritrade. There you go, downtrend line. Rally right into that downtrend line right now, so we're at resistance. We are a little bit above. It did take out that 54.35 support or resistance. It was support back here. It was a reaction high there, but again, you're right at about downtrend line resistance. You can zoom in, say you're hair above, but we haven't closed a week, so actually we're even where the prices are right on it now. So that's a level to watch. And again, I'm doing this because it's a common theme here. These U.S. and Canadian banks tend to move together quite often, not always, but right now you have a lot of them, both U.S. and Canadian banks at resistance. Some of the big banks, and here's a Japanese bank, Banco Santander, International Bank, and there's a nice divergent low. So again, it's these with the divergent lows that have rallied quite a bit. That one's up about 100%. It's going to move more as well. It's smaller than, of course, the big U.S. banks that I already covered. And then what stands out as well would be the fact that it's rallied into this resistance level. There's our major reaction lows from back in 2016. Another reaction low there it was tested back in 2019, and finally it broke that support. That was a pretty significant support. Once it broke, there was waterfall selling, and now we've rallied back to the trend line with support just above. So upside appears to be very minimal. The risk reward right now, despite that big divergent low. In other words, if my most optimistic scenario would be that we just at least get a correction, and it would be a tradable correction. Remember, this is a weekly chart. Pull back like that, what would be worth trading. So that would be my most bullish outlook, is that, hey, maybe the financials are going to have a correction soon and then put another leg up, whereas it also could be the end of the run. We'll just have to see what happens. First of all, do we even get rejected off these resistance levels, and then we go from there. BNS, Bank of Nova Scotia, you see a lot of white circles here, and what those circles up top are, these circles down here, overbought. Overbought is when you hit this red line here, the 70 level on the RSI, and it's pretty simple stuff. When you're overbought, the risk reward is not very attractive anymore to being long. So you either raise stops, take profits, or get ready to short. And remember, we're looking at a weekly chart. So these pullbacks ranged from, let me find, this is probably the smallest one right here, and that drop was about 14%. And the biggest drop right there from an oversold reading in recent years was this one, about 50%. And anywhere in between. Here's one back there after oversold reading, dropped about 27%. So you can decide whether you want to go long BNS right now, or you want to go short, or wait for a decent sell signal. But not only are we oversold for the first time since 2017 right here, which put in this major top, by the way, and that one, before all said and done, the stock fell 52%. This is the first time we're oversold since that point in time. One thing to note on oversold, and I've said this many times, but it bears repeating, oversold is not a sell signal. It is a condition of the stock, and it says that upside's probably limited. But quite often you hit, if you look closely, you hit oversold, and then you hit it again. You get these double tap readings. Sometimes they result in divergence. So thing is, oversold could stay oversold for a period of weeks, and even maybe a couple months or a few months, or sometimes it's one and done. So, you can't always just say, well, the first tag isn't going to be the one that ends it. Maybe there'll be a little correction. That was the first oversold tag there, and you pushed up and made a second one. It's just worth noting. So if I follow up on this video a few weeks from now and we are oversold again, that increases the odds we're going to have a major trend change. But again, sometimes it is boom, one and done, one and done. And that's why you need to really respect these overbought conditions. If I said oversold, I meant to say overbought. This is oversold right here. Okay, just a couple more. WPK, that's Westpac Banking Corp, Sumitomo, Japanese Bank, UBS, and that's it. BMO. Oh, okay, there's another, the last one, we'll stop here. Another Canadian bank, and same thing. Bank of Montreal, oversold right now. And again, you can do the math on measuring out these previous oversold moves, and like I said, they're going to all be double-digit corrections. So that's what I call swing tradable. Anytime you can position for a move that you expect at least double-digit gain, you can position for a swing trade, usually lasting weeks, if not months. Okay, now we'll just recycle through the same banks, but on a daily time frame to kind of sharpen our pencil a little bit and see what levels may determine the near-term trend. In other words, when might we get some sell signals? So I'm zooming in on JP Morgan. Again, we're looking at daily charts now. Here's a level that stands out. I colored it in blue. About we'll call it give or take about 120. And why is that level significant? Well, we have a lot of reactions there in recent years. We're going back here to 2017, early 2018 on that first circle actually. And then we had a breakout right there. A breakout that failed, and when it failed, it was powerful. That was dropping to the March lows. We're above it now, so for the time being, this is far from a sell signal. In fact, it's a breakout. So if it can hold above that level and that level sticks, and the breakout continues, great. Otherwise, I expect or suspect this will be a what I call momentum fueled overshoot, a brief breakout followed by a move back down. What might trigger the sell signal? Well, a lot of these banks, you can draw uptrend lines right now, and like I showed you in QQQ, we had a breakdown recently above this trend line here, but it was not impulsive. So I think a drop back down below 119.40 or so should do the trick, and you'll probably start to see accelerating momentum to the downside on JP Morgan. And again, keep in mind, you want to see other big banks break down. If JP Morgan breaks down, but then Bank of America and Citigroup and Wells Fargo are still rallying, well, guess what? JP Morgan probably isn't going to go very far. Birds of a feather flock together. So the more of these banks you can see break down, the higher the probability is that you're going to have a swing short that's going to put some money in your pocket. BAC, Bank of America. There's your uptrend line, daily chart. Also worth noting, this high is a marginal new high, so you have some pretty big negative divergence there here on the daily time frame. And again, there's your trend line. I haven't zeroed in on all these levels. I probably could and I should update these charts, and I definitely will, especially if we start to see some of these stocks break down. So there's your level. Again, we're just starting to crack. So I already pointed out a lot of these stocks were at resistance on the weekly charts, and some like Bank of America here are at resistance on the daily chart. There's a major reaction, previous reaction high right there. So a case can be made, and we're starting to crack. It's not impulsive, so what you might do if you want to take a starter position, maybe a half position, add on if these guys continue down, maybe on a gap down later this week or next week. That's why it's sometimes nice to have that starter position. You get a big gap down one day because there's a news event overnight. Markets open way down. It's a little more comfortable to add to that position once you already have a profit on your initial position. Otherwise, you can just wait for a little more evidence. Like I said, the trend is strong, and maybe they shrugs off Bank of America and JP Morgan shrug off these recent breakdowns. Again, they're not impulsive breakdowns, so it's not the ideal all-in short opportunity. HSBC, there's an uptrend line. A common theme too as I'm doing the video. The vast majority, these stocks have started to break down already, and so if we have another red day tomorrow, that's going to increase the odds that these breakdowns stick if we can get some more downside here. Well, where does HSBC go? Well, first of all, let's talk about where it's gone so far up. We had a beautiful downtrend line here, big positive divergence on the PPO down there, oversold, and we broke out right here, and that was our rally on the breakout right here. Since then, we set up on that uptrend line. We also ran into this. I have resistance about $27, and so what we're looking at, and again, this is what I said on some of the other ones that have just overshot resistance on the daily or slightly on the weekly. I think they're going to prove to be momentum-fueled overshoots. There's been a lot of kind of, I don't want to call it panic buying, but I think this rally is a little bit overdone, and I think again that momentum has carried some of these stocks past there. But the fact this one has now fallen back below 27, then that increases the odds that we're going to head on down. Please pardon all the noise in the background. I have construction going on at the house. Even though my office doors are closed, I can hear the sawing right through there. And my apologies if it's distorting the video. Almost done here anyways. Citigroup. Nice uptrend lines. Again, common theme. Citigroup has not cracked that uptrend line yet, but maybe getting close. Other things to look at. PPO is starting to turn back down. It hasn't made a bearish crossover yet, but you want to look for that. Last time we had a bearish crossover right here, and big correction followed. Overbought as well. Last time we were overbought was right there as well. So from that overbought reading, you know, had you put on a short and held it, let's just say, you know, theoretically, until you had a divergent low, you were looking at a 35% drop in Citigroup. So similar conditions, bearish crossover pending, overbought conditions, and then the last time before that we were overbought was right here, and you can see what happened there, an even bigger drop. So, you know, watch, rinse, repeat. This is why I'm doing the video. I'm seeing a lot that stands out in this sector. I know, you know, a lot of people are probably, the minute I said it was going to be, you know, talking about short setups and bear setups in the financials, probably those people probably stopped watching the video. But I would rather talk about, you know, a potential turn in the sector before it happens than after, and that's what I'm doing here. Because I can tell you things tend to, and if it wouldn't surprise me at all. In fact, I'm leaning towards, once the tide finally turns, there could be a very swift correction due to the extreme sentiment and everything else I've covered recently. We could see a pretty quick rush for the exits. Again, that's why I want to get these out in advance, whether I'm a little early on this or whether, you know, it started today. I mean, possibly there's a breakdown in Wells Fargo daily chart. You have these nice clean uptrend lines, and we're below trend there. So I think the video is pretty timely. And again, for those of you that are looking for short trades, where would Wells Fargo go on a pullback? Well, you can see right there, 26.50 I think is a nice level to watch, or target. And again, that's for a quick pullback trade. We could certainly see more based on what I showed you on the weekly charts, long-term resistance, but that'd be about an 8.5% drop. RY, Royal Bank of Canada, similar thing. Even though this is a Canadian bank, there's your uptrend line. Let me move this. Yeah, it's tight enough. We broke down, but like everything else, the market's holding up, so there's not impulsive selling yet, but we are below trend. So what I think is going on here, RY is just waiting for some of the other big banks to break down, and then for everyone to start to become clear to the masses that the financials are starting to correct. Right now, you certainly can't say that. They're in an uptrend, and so a stock like this that breaks down ahead of the pack will usually start to fall pretty sharp once it's clear to others, you know, once you start to see a lot of the other big banks break down as well. TD, another one, broke down. It's actually moved a little higher. Potential bearish crossover down here, not yet happened. We're waiting to see that, at least a solid crossover. Overbought, last time we were overbought was right here. So again, you know, you do the math on you know, whether it makes sense to be going long right now or to be going short, or at least to be getting ready to go short. So that's TD, Toronto Dominion Bank. All right, that's about it. I covered this one on there. Banco Santander, downtrend line, rallied into resistance. You know, nice divergent low. But how much of that 96% or 92% run has already been priced in? So again, at best, this appears to be the first leg up with a correction to come, and maybe another leg up. We'll see. Okay, I had a brief interruption there. Contractor needed to get with me on something. And to kind of wrap it up here, I think there's just one more bank we looked at, one or two Canadian banks. All right, so there it is. You're overbought into resistance. That in itself, gives you a reason or an objective short entry if you want to take one. But then to further narrow it down, let's jump down to a 60-minute time frame, and then you can look at drawing an uptrend line right here, which we have. I can see we have negative divergence, which helps support the case for a trend reversal right there. And that's it. That'd be your trend line break. We could draw. I could identify some targets here for pullbacks, pullback targets, that is. Probably look at, yeah, there we go. That reaction high. You have some reaction highs there. So there's a minimum pullback target. From where we're at now, that'd be a drop of about 11.5%. That second target there would be about 16.5%. Likewise, you had a comparable setup back there. There was an uptrend line. You had your divergence here on the RSI, and there was your sell signal. And there's a case where you gap down. So if you anticipated the breakdown, like you could do right now, you could take that starter position or even a full position if you're aggressive, then you would have had a position in place when it gapped down 5.5% that day. That's what often happens when these setups are pretty well defined and a lot of eyes are on them. Instead of making it easy and breaking down and then dropping 5.5%, letting you in, a lot of times the market won't let you in, or at least deny an objective entry. A lot of people don't want to short stock that gaps down 5.5%. They think they missed most of the run, and you missed most of the initial run. There was more to come, but ultimately, before all said and done, even if you shorted that 5.5% drop, you still made another 30%. The stock had another 30% to go. Okay, two more. I think I covered BNS for you Canadians. I know there's quite a few on the website. There's BNS at a downtrend line resistance, so there's your objective case to short. And again, you want to study jump down to the 60-minute time frames, hone down on your entry. You've got this bearish rising wedge pattern, negative divergence, and that's that. And finally, I think I covered BMO as well, Bank of Montreal. Daily chart, I haven't updated this one in a while. There was a little trend line break there. Coming up on resistance around $79. Really steep advance here. I don't know how much more, how sustainable that is, but there's a similar uptrend line. So there's the common theme here. You can drill down to the 60-minute charts on a lot of these stocks and kind of hone in on your entries. But as I showed you on the weekly charts and daily charts, majority of these bank stocks overbought and at resistance. So just as a few weeks back, the energy sector was the most bullish sector out of the S&P 500. Right now, the financials, in my opinion, is setting up as one of the more bearish sectors, even though the trend is currently bullish at this point in time. We'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.